This week's update is the end in sight for the bond bull market and lessons from Karelian's collapse. The big investment story of the past week has not been in the stock market, but the far bigger and arguably more important bond market, where fears are growing that a 37-year bull market is living on borrowed time. Bonds have been rising in value for longer than most investment professionals have been working. The bond bull market began in 1981 when prices of fixed income investments were at rock bottom in an environment of punishing interest rates as Fed Chairman Paul Volcker declared war on sky-high inflation. Winning that war, together with long-term deflationary forces such as the introduction of China into the global economy, has seen interest rates and so bond yields fall progressively for more than a generation to today's historic lows. Because bond yields and bond prices move in opposite directions, the collapse in yields has accompanied an unparalleled rise in bond prices. The fear today is that the tide is finally turning and bond yields are now heading upwards again. Last week, the yield on the 10-year US Treasury bond, a key benchmark, rose to 2.6%. That might not sound very high, and it's not compared with the 16% reached in 1981, but it is around twice the 1.36% low reached in 2016. What's driving bond yields higher is the belief that the economy is finally healing after the financial crisis. Inflation, absent for so long, is on the way back. Unemployment has fallen to levels at which in the past a scarcity of workers has begun to push wage inflation higher. And the big concern is that Donald Trump's tax cuts on the back of an already tight jobs market will pour fuel onto an already smouldering fire. The reason that markets are so worried about rising bond yields is that they form the bedrock of the global financial system. Low yields support cheap lending to companies and individuals, and they also justify lower yields on shares, pushing up their price. They make life difficult for savers and so force them into riskier investments like bonds and shares. So, rising bond yields are not just a technical issue. They threaten the bull market in equities and the current high level of property prices too. Last week, some of the biggest names in bond investment made precisely that case. Bill Gross, the former PIMCO investor, sometimes called the Bond King, said in a tweet that a bear market had begun in bonds. His funds, he said, were selling US Treasuries short, a bet that he will be able to buy them back more cheaply in future. A couple of other events last week added weight to bond investors' fears. First, Japan started to rein in its purchases of bonds, joining other major central banks in withdrawing extraordinary levels of stimulus from their economies. Then, a day later, speculation swirled around China's intentions, suggesting that one of the biggest holders of US government debt was turning lukewarm on its Treasury investments. Not everyone is convinced that the end is really nigh for the bond bull market. For one thing, inflation really is still hard to find all around the world, and without it, bond yields are unlikely to rise very far. There are other reasons to expect interest rates and bond yields to stay low too. Aging populations imply a greater demand for relatively safe investments like bonds. Debts around the world are still worryingly high, and the headline jobs figures in some cases flatter the real situation where many people have simply given up the search for work. So, the jury is out, but make no mistake, the direction of the bond market from here is the most important question facing investors today. A second significant market movement this week has been in currencies, where the dollar is trading at a 3-year low against the euro. It's also heading back towards pre-referendum levels against the pound. Driving the euro higher has been Angela Merkel's success in forging a coalition deal. The pound has benefited from hopes that the EU is prepared to entertain softer departure terms for Britain. More generally, the dollar is fading as it becomes clear that monetary tightening may not be the sole preserve of the Federal Reserve. If other central banks begin to squeeze interest rates higher, the relative yield advantage of the dollar will fade. Another big market story this week in the UK has focused on the collapse of one of the biggest suppliers of construction and other support services to the government. Karelian is a name that many people will not recognise, but they will have heard of the many big construction companies that were put together to form the company. Tarmac, Wimpey, McAlpine and Molem bring a long heritage to Karelian, so its liquidation this week is a big deal. The company employs more than 40,000, including nearly 20,000 in the UK, and it's involved in some high-profile projects for the government, including the HS2 high-speed rail link and Crossrail. It's been fighting for its life since July, when it warned that it was losing money on key contracts and its debts were rising. It passed its dividend and parted company with its chief executive. Before its collapse, it owed £900 million and had a £650 million pension liability. By the time its shares were suspended, its value had fallen to only £60 million, and now shareholders have been wiped out completely. Many will lose their jobs and others will receive lower pensions. The collapse of the company is controversial because the government continued to give it contracts even after it had warned on profits. And questions are being asked about why the government was prepared to work with Karelian after it was evident that big problems existed. For investors, there are lessons too, because there have been plenty of hedge funds betting against the company for a number of years now, simply not believing that the company's finances were sustainable. As with other companies involved in public-private partnerships, Karelian was faced with wafer-thin margins as companies raced to the bottom in order to secure work. The problem was that these margins left no room for error. As things went wrong, it had to find ever more new business to win upfront payments to plug the gap in other contracts that were loss-making and cash flow negative. It was a kind of desperate Ponzi scheme. The main lesson to be taken from this sorry tale is that if something looks too good to be true, it probably is. It makes a strong case for rigorous fundamental analysis too, and not simply buying a share passively on the basis of its market size. At its recent peak, Karelian was valued at £2 billion and would therefore have appeared in many market tracking funds. Elsewhere in the corporate world, earnings season is getting underway in the US. As usual, the banks have kicked things off with JP Chase and Wells Fargo last week, followed in quick succession by Citigroup, Goldman Sachs, Bank of America and Morgan Stanley this week. The picture is expected to be quite confused, with the Trump tax reforms likely to result in a mess of one-off charges, accelerated expenses and one-off bonuses to staff. On this side of the Atlantic, the focus has continued to be on retailers, with a string of results over the past week painting a mixed picture. The supermarkets, Morrison, Sainsbury and Tesco, all reported year-on-year rises in grocery sales, but shoppers steered clear of clothing and general merchandise purchases. Mothercare lost a quarter of its value after warning on profits, and Marks & Spencer announced an accelerated rate of decline in its clothing sales. John Lewis increased Christmas sales, but said these had come at the expense of margins. This week we should get official data on retail sales, with expectations for a small overall rise in December as food sales increases outweighed weaknesses elsewhere. Also expected this week in the UK is the first inflation data of 2018. Having reached a high of 3.1% in November, prices are expected to have risen fractionally more slowly in December and to fall further from here as the impact of sterling's fall and the higher cost of imports implied by the pound's weakness start to fall out of the year-on-year comparisons. And elsewhere, the main economic stat investors will be keeping an eye on this week will be China's fourth quarter GDP figures. Growth is expected to have been 6.7% in the 3 months to December. That's a touch lower than the 6.8% growth in the previous period. The government set a target of around 6.5% for 2017, so fears of a slowdown in the world's biggest emerging market are likely to be allayed by the latest figures.